Hello, everyone, and welcome to another episode of the Property Trio. And today we're doing our December market update. So ostensibly the 2023 final sort of year update. And joining me, as always, my lovely co-hosts, Cate and Dave Johnston.
Good to see you, Mr. Mortland.
G'day, Mike.
How are we doing?
Yeah, we're in holiday mode. It's great.
Looks like for anyone on YouTube that Dave can't afford his power bill. What's going on there, Dave? You're not very backlit.
I'm not sure why it's a bit darker today.
Those Victorian land tax changes?
Could be. Yeah, I can't pay the electricity bills.
Maybe he's got like the blue light, not the yellow light.
I hesitate to say in the news because I never know how far we are from actually going live. But what is in the news is the stage 3 tax cuts. So
sure is.
They are
so annoying. I did a big blog and it took me ages. You know, what's in store and what does it mean and what markets will be affected? Now I've got to go back and rehash the whole bloody thing. But anyway.
Yes. The reason why I was comfortable saying it is because I think it's going to be in the news for months and months and months and months and months and possibly all the way up to the federal election in 2025, which is horrifying to think.
Yeah. Well, it's given the Liberal Party a free kick to having a really strong message about trustworthiness and broken promises. And I just wonder, Albo thinks that the middle earners will forgive the broken promise because they've got a bit of money in their pocket, but I'm just not sure.
Yeah, they've pushed it up to 30 cents to $135,000 salary, but then kept the 37 cents bracket from 135 to 180. If I'm not mistaken, and it was going to be 30 cents in the dollar from 45,000 to 200,000, which would have been a great win for everybody, sort of in that 37, middle to high income, and so they've obviously done their numbers and probably felt that the majority of their voters and what's going to get them over the line is perhaps ballpark up to that $135,000 salary mark. It'll be interesting to see how it plays out.
Such an interesting debate. When I first looked at the proposed tax cuts, I remember saying to Ian, why are they giving more tax relief to the higher income earners? So a lot of people would be thinking, it's not a bad thing that they've changed it up. But the whole point around this was about bracket creep. Because we've been in such a high inflationary market. So it's not actually about who deserves tax relief. We've had stages 1 and stages 2, and that was aimed at the lower income earners. And I think there was a lot of science that went into this, right or wrong. I certainly don't want to take a political stance on it. I think a broken promise, though, is an interesting thing to watch in terms of what the electorate does and how those higher income earners that have voted Labor will feel about this. And I don't think it's about the loss of $4,000 over the course of a year for a high income earner that would make them turn on their heel. I think the promise is probably the more significant component.
Yes, one of our more analytical friends has already counted that there was 32 times that Albo confirmed that the stage 3 tax cuts would go ahead. So that broken promise is worth something. And I think they've probably just gone, all right, well, let's look at all the brackets. Who would vote for us? Okay, give them more. Yeah. Who would vote for the Liberals? Well, they can get stuffed. It's got that feel about it.
100%. Where do the percentages lie? I think it's totally a numbers game. And they've gone, how much the high end willing to wear and how many of them vote for us? And, where are we actually creating greater benefit for what percentage of the population and how many votes? It does feel very cynical.
Yeah.
Let us know your thoughts at the Facebook page, or let's say Cate or Dave's email address. We should get into the show. The December market update. We are missing a little bit of data because all of these economists and data houses like to go on holidays, which is appalling. But we do have the updated December figures. And really this puts an exclamation mark on the year that was 2024. Perhaps starting with you, Dave.
2023.
2023. Gosh, I've still
getting a year ahead of ourselves.
Oh, I know.
We haven't got as many years left, Mike, we don't want to
I know.
rush through them too fast.
Shouldn't accelerate. Even myself, as the young pup of the crew, I'm still old.
Arguably got more years ahead of you.
Yeah, not the way I've lived. It's a side story. Dave, what's the big standout? And I mean, obviously we've got the big three. We've got Perth, we've got Brisbane, and we've got Sydney sort of leading the charge. What's your big takeaway?
Oh, look, I've got a few sound bites that I've made notes on, but maybe we can work our way through them. But look, if we just start, say, with the month of December itself versus the whole year, It was the smallest gain since February 2023 at 0.4%. So we're certainly seeing a broader slowdown in property growth towards the end of the year after that last rate rise in November. How long that will last, time will tell. We're certainly seeing the tale of two sets of cities, if you like. I've sort of broken it into, we've talked a bit about this, but I've broken into the mining related capital cities. So, Perth, 1.5 growth, Brisbane, 1%. I mean, Adelaide's not really mining. So it's not. So, yeah, look, it has 1.3. And then Darwin, we've spoke about, keep an eye on Darwin. Well, it actually bumped up in December to 0.7% growth. And then we saw with Sydney, only just above 0.2, Canberra negative 0.1, Hobart negative 0.3, and Melbourne negative 0.3. So, yeah, we're sort of seeing a two-speed property economy, if you like, across those 8 capital cities, aren't we?
And Cate, we did, of course, a special on Perth, and Perth continues to hum along with 5.1% growth for the quarter, giving us 15.2%. It's
Perth's a real story. It's an interesting story, and talking to agent advocates over there, they're getting a lot of investor demand. And what we know about investors is they're rational until they get irrational, and everybody wants a piece of Perth at the moment. No surprises there. But I looked at this chart, and I note that Dave has commented on it being down for December, and he's absolutely right. But we kind of peaked early this year, and not just in terms of people activity. We also had our listings run down, and across the board. One annoying thing about the CoreLogic data report for the month of December is that the only bit of data they haven't given us is listing activity. So I'm running on anecdotal information here, and I know that the agents have been reluctant to bring forward any listings that they have planned for 2024 because everybody wanted to have a bit of fun in 2024. So we ran out of listings pretty early, and in addition, we really treated this summer like the old summers that we used to enjoy pre-COVID. As an agent, I always wound things up in mid-December, had the Christmas party, closed the office, cleaned the fridge, said adios to everyone, and I'd see my staff again in 4 or 5 weeks. And that's what we've done this year, and it's what a lot of people have done, because the last 3 summers, we've all just gone, we're not closing the office, we're available for Jan, we're not going anywhere because we can't, and we'll take whatever business we can get because we were locked down and couldn't make revenue. So it's an unusual year to compare to past years, but it's actually been a lot like traditional years.
Yeah, I 100% agree. I think 2023 was the first year we started to live normally without really any COVID sort of interruptions since COVID hit. And I think, I know anecdotally around us, like everyone was back into, the kids doing all the sport they could do and, extracurricular activities and hanging out with friends and social activities. And I think we lived 2023 like we used to live. And everyone was just tired at the end of the year. And so no one wanted to work. No one wanted to put on new listings, and that flew through to the property market. And that's sort of, what's played out, what you're talking about there.
Yeah, exactly. I look at these greater numbers, Mike. Rather than focusing on the month or the quarter, I've looked at the annual data, looked at it and said, well, how did 2023 wrap up? What is interesting is the combined capitals median value is above Melbourne and Brisbane, and obviously Adelaide. and Canberra. Sorry, Canberra's only slightly above it. So Sydney's done all that heavy lifting to raise our combined capital median value. And I also note that when we look at a total return, so the first three columns are all about capital growth return, but total return includes rental return.
Yep.
And we're looking at a 4% component for the national figure. We haven't had a 4% rental return for our national figure in a long, long time. And that's vacancy rates and rental increases at work.
Yeah, absolutely. One thing that stands out to me as well, keen to get both your thoughts on it, is that at the end of the year, we saw the combined capitals outpace the regions by essentially double. But in the last quarter and in the last month, they seem to be matching each other. So have the regionals kind of found their bottom as distinct from the capitals? We've seen that kind of. We saw the mass exodus, and then the CEO saying, "Get back into the office," and maybe now that's settled.
Yeah, well, you can see for the quarter they're both 1.5, and there's always data lag. I maintain that mid last year was when they bottomed out, and some bottomed out more than others, but they came off a little bit, the big ones, and then they're back on. And stock shortages helped that.
Yeah, I think the problem with the regional numbers is it's so diverse. We've got really big regions in there. We've got, I think, Gold Coast is included in the regions, and then we've got, the small coastal towns and small inland towns as well. We know that some of the more, well-known holiday venues or locations that rose to ridiculous numbers, think Byron Bay, think sort of perhaps Sorrento, Portsea, etc., have had really large falls in 2023, and that's possibly still playing out. CoreLogic released some data on this just in the last week or so that our listeners might have seen. So I think there's like we always talk about, there's layers to this. But I think, the commutable large regional cities probably are starting to find an equilibrium, around where their peaks were. And I think that's what's happened to some degree across the capital cities that aren't performing as well. Like if we look at where they're at relative to their peaks, like Sydney's just 2% below its 2022 peak. Darwin 2.8% below its 2022 peak. Melbourne 4% below its 2022 peak. So Perth, Adelaide and Brisbane are now above their 2022 peaks, but I think that's playing out in the major regional centres as well. People go, look, our prices, they're back, give or take, around what we were paying when prices were frothy. That feels about right with the inflation and the growth in our salaries and et cetera. So I think but I think some of those real frothy, really popular, well-known holiday locations, people are still going, those prices were ridiculous. We're not going back there for years.
I like the term frothy. I personally don't think I've had a beer for a week, so I'm getting real thirsty.
What's going on?
I'm not letting 10:51 a.m. stop me.
Well, it is Australia Day tomorrow, Mike. So.
There you go. There you go. And isn't that a contentious issue? But we're not going to even bring that up. I want to talk about rents. Now, before we look at the data, I want to share a personal anecdote. Now, we've had feedback that, people like a little banter, but not too much. So I'm going to push the boundaries. So I was in Brisbane at a box event at the Big Bash watching the cricket. And I knew that I had a press release going out the following day. What I didn't know is that it was going to go out at about 5:30 a.m. to try and catch some breakfast radio. We commissioned some data looking at where there were locations that had at least 100 rental properties in the postcode and how many properties were actually advertised for rent in the month of December. And many of them that had 100 or more only really had one listed. That went gangbusters in media. I had a knockoff Paddy's Markets Tommy Hilfiger T-shirt that I bought for about $5 on, a scruffy face and a suit jacket that I luckily packed, and was on television 3 times before I brushed my teeth. It was ordinary.
Still hungover, right?
Oh, I was firing. I channeled my inner Christopher Hitchens, who's a real hero of mine. So there's a word of warning to people, is just to have a little bit more preparation. But I got it done, and we got the story, and it did go across Channel 7 and Channel 9. And you know, in essence, we're in a rental crisis. We're in a national rental crisis. The media are really starting to talk about it now. However, it's been 7 or 8 years in the making. You know, you talk about the interest-only caps, you know, serviceability buffers, the higher rates that investors pay, the negative gearing to elections that we went to, minimum standards, land tax, you know, I could go on, right? But now we are really seeing the year that was 2023, what happened to rents. Over to you two.
Great lead in, Mike. Fantastic
Nice
lead
lead
in.
in.
Well, look, I mean, yeah.
Have a look at these charts, and they'll be embedded in the show notes. Late last year, we were thinking that the rate of growth might have been petering off. We saw the charts, you know, heading up and then slightly curving off. They're back up. Bit scary. So I'm looking at houses. Every single chart has something that's tricking up except Hobart and maybe Canberra.
Now, is there a seasonability that made a December blip kind of give us an incorrect view of what's happening?
Without a doubt.
I can't
don't
see.
want to move around Christmas time. They just don't. I say to all of my clients, get your property online for rental as early as you can, because by that second week of December, probably not going to happen. This year, I actually listed a property of ours, I think on about the 17th of December, and we'd done a little reno and we just needed to make sure things were finished before we put it on the rental market. And I was thinking to myself, this won't get any traction anyway. It did. Got a lot of traction, and we had a tenant move in just between Christmas and New Year, which was quite incredible. But the point is, listing activity and tenant take-up is always lower in December.
Yeah, but I do think it's a time when people make the decisions to move on from a rental. So even anecdotally, like talking to friends and people I know who, you know, rent investors, or, you know, have moved into state and so they've been renting but now looking to buy, or they're just, I feel like I'm talking to more people who are leaving rentals right now than happens during the year. So I think a lot of people make that decision now, but it's also when there's the least stock available. So it's going to be interesting to see how it plays out. I mean, look, 2023, back on, I think your points are really well made, Mike. I think this problem is a decade in the making. And we know, look, over the last decade or so, the average rent has been 2%. And then we've had 9.6% growth in 2021, 9.5% in 2022, and 8.3% last year. So we've had three, but it's really making up, like we've talked about, and good old the property professor Peter's research told us as well. I mean, rents have been below inflation for over a decade. So the reality is renters have had it pretty good for a long time. And unfortunately, they're being hit with a flurry of just, you know, in these 3 years. And if you happen to be renting during this period, well, you know, it's really, really tough for you. That's for sure.
Yeah.
I can't see anything out there that gives me an indication that things are getting better. We've sort of seen some of the pace moderate, but I think what is really just happening is that people are making different decisions to skirt the issue, right? Which might be more people per dwelling. It might be staying at home with the parents. Like people, like rents can't go up to a median of $5,000 a week across the country, right?
No.
Nobody can afford that, right? So there is a ceiling of what people will be prepared to afford until they make other decisions, which, you know, horrifically might mean like living in tents or sleeping in a car or something for some people. And then that's the real horrifying effect of this plan that's been so long in the making. But what I actually suspect is that I don't think the pace can continue to grow as fast as it will, but the pressure is still 100% there. And I think what will happen is that we will head into this 2025 federal election and we'll be talking more about the negative gearing word, the buzzword. And I think there'll be so much miscommunication around that because the ATO data will start showing that because interest rates are so high, there will be a short period of higher negative gearing losses. And I think that's going to potentially even scare more investors out of the marketplace and make it worse. No matter what your position on this issue is, if you care about tenants and people that need to find housing accommodation, those scare campaigns are bad news for them. What do you guys think?
1,000%. I agree with you, Mike.
I love it when you do that.
Look, I think there's so many layers to this topic that we really could do a whole episode on it. And I feel like sometimes when you try to put together a minute statement on something that big, you don't really do it justice, as in myself or any of us. So yeah, I've got too many things going through my mind on that point, Mike. So I think, like, where do you start? I mean, I can make a few points, but they lead to us talking on another show. So I think it's going to be big. There's going to be a lot of news. It's going to be a big story. But ultimately the solution is building more property at a faster rate. And that's going to take a lot of coordination between governments and councils. And that's going to take years. And governments are going to throw little policy solutions that aren't going to solve the whole problem. And they're going to put some people off and they're going to turn some people on. And they're mostly going to aim them at the people who they believe vote for them and or the swing voters they're trying to get across the line. So what that throws up in terms of policy, who the hell knows? Honestly, who knows? Like, it could be something to do with negative gearing, and if you own more than 3 properties, I think one day that's going to be cracked down on, but whether that's in a year or whether it's in 10 years, who knows? I think, there's going to be things like that done, but to actually, try to guess or predict is folly.
What I will predict is that the chart for rents next month, so once we get the Jan data, I predict that it won't be looking like we're getting better. It will look worse. I think we'll see higher increases across the board.
I think you're right, and I think we can guarantee that there'll be some sort of announcement, some sort of intervention. But what you can definitely take to the bank is that here at the Property Trio, we will guide you through all of those machinations across 2024. So like, subscribe, share, all the stuff that you're supposed to say. Now, what we don't have because of the skeleton staff are listings data and vacancy rates, but we do have gross rental yields across the country. And, it's weird to see places like Sydney and Melbourne doing 3 and 3.5%.
Yeah.
Many of these.
Do you know what? That's what they used to look like when I first got into mortgage broking and banking 25 years ago. You're submitting a loan approval for someone looking to buy an investment property. Estimated rental yield 4% back in the day, and it's gradually come down over, and it's turned in the last 3 years, but it's getting closer to what it used to be, that sort of 3.5% to 4% consistently as a yield.
Yeah.
It's more reasonable, isn't it?
3.71 nationally. I mean, we've got some areas doing some really good heavy lifting, and I know what Perth has been doing, but to not be in the twos, Dave, I remember calculating a gross rental yield for someone buying in the Leafy East out in your neighbourhood, and they were really upset with me, but that their rental yield was looking like it was around 1.5%.
Yeah, 100%. I mean, yeah. Well, capital growth, and there is some good data's come out the last week that the highest value suburbs in Melbourne and Sydney are the ones that have outperformed the most over the last decade. which we could potentially get into show notes, or maybe Anne Marie can get that into show notes. But yeah, you certainly pay for it in the yield, that's for sure. And Melbourne and Sydney, you've had yields in under 2% in some of those beautiful leafy eastern suburbs.
That precludes investors on normal incomes. It only opens up the
It
door
does.
to high income earners.
No doubt.
Whereas regional Northern Territory, that's where the smart money is. I don't want to be quoted as saying 6.9%.
I'm concerned about volatility and vacancy rates and all kinds of issues there.
That's why we're not going to carry on with that nonsense.
Well, look, just on rents, so just a couple of quick numbers with Perth. So units increased by 16.5%, the cost of renting a unit in Perth over the last 12 months.
Yeah.
Now, that location, I'll remind our listeners, I've shared the data on the percentage of units in each capital city. Perth has the lowest percentage of units of any capital city in the country. Now, that Perth is ripe for developers to get in there and build some more units right now. So it wouldn't surprise me if we start to see, that to happen in the next year or two in Perth.
Now that sounds like a big figure, Dave, but Sydney beat it during 2022. Sydney peaked around 18% for units, which is amazing because there's a lot of units in Sydney, so that speaks volumes. And I look at Darwin, I know it's a very different capital city, but that skyrocketed to something like 24% during COVID.
Yeah.
People dashed up there and wanted a piece of Darwin. Frankly, I would have liked a bit of Darwin as well.
Yeah, bit of freedom and warmth.
Yeah.
There's some different stuff that goes on up there.
Sales listings.
Yes, we don't have listings data though, do we?
Only
listings?
Sales. We've got sales listings, but not listings.
So tell us what's happening there, Kate.
Well, we've got the 5-year average and monthly sales volume. So not just the deals that were advertised for sale, but the ones that sold. That tricked under the 5-year average pretty quickly at the end of the year. So it was above for mid 2023. And then it plummeted. And that goes back to my point. We ran out of stock.
Yeah.
We had pretty good stock volumes halfway through last year, and then we bought it all. Done, finished.
Now, the spring selling season is a thing that we've talked about a bit, that we hadn't really had a proper spring selling season. Now, forgive me, but the next season is one where the leaves fall off, right? So that's not the spring one.
Autumn.
Are we expecting the leaf, as the boffins call it, or fall for our American friends? Are we expecting a fall listing influx?
Yeah, I am. I mean, the agents certainly promised us that we had a lot coming, and I actually planned my holiday to be back in the saddle on the 15th of Jan. And I got back here, I was twiddling my thumbs and calling agents, and then voicemails were saying that they were away. And I thought, what's happening? You all told us that you'd have lots of listings coming early in the year for your February auctions. And the reality is we would know about it if we had a lot of February auctions. And we have a few. I would say it's as many as other historical normal years. But I'm anticipating that we'll see quite a bit in March. We've got an earlier Easter this year. It's at the very end of March. And I think that if the agents are telling us the truth, we'll see a lot of listings hit between now and Easter. And that will probably give rise to some good buying conditions for buyers and investors. I do note, though, a lot of the agents are saying that it's investor stock that they've got. So all of those, 4 and 5 bedroom renovated home buyers out there who are hoping I'm saying something spectacularly exciting, they might be out of luck. We might have normal volumes of family homes, but I'm expecting that we'll see a lot of investment stock.
So with you, Kate, your business, you help property investors, you help owner occupiers, and you tend to ride the waves of who's kind of in vogue. At one point in time, you might be 80% investor and 20% owner occ, and then it kind of flows. Where are you at now with
it's
inquiring?
80-20 right now.
80-20 owner occ.
Yes. Yeah.
Right.
Victoria's not a popular destination for investment right now. The investors that I do have are usually Sydney-siders or people overseas. I've
Yeah.
got a lot of investors that I've worked with in the last year have been buying a property to pop a tenant in, but they've been looking at coming back to Melbourne. So it really has been an accidental sort of reverse investment where they've wanted to have me find them their ideal home that's suitable in the short term for being rented out.
Now, what's happening in the political sphere in Victoria? Are we likely to see the land tax legislation be repealed?
I don't
No.
know. After Queensland, I was moderately hopeful. What I will say is I won't fall off my chair if it's repealed, but I think that our silly government needs to see a lot more pain and join the dots and see that they've contributed significantly to it before they go admitting that they've gone too hard in the tenant's direction.
I don't think we will, to be honest. It's not really talked about in the media at all.
I think we need to see a lot more.
It wasn't anywhere near as severe as Queensland's. I mean, Queensland's affected the whole country. Every property investor in the country who owned multiple properties, including one in Queensland. Whereas this is, for most people, it's probably increased their land tax by 5 or 10% for the average investor. So it's not massive. I mean, for some people it is. And obviously the more properties you own or the more value of land, investment, property land that you own, it's a bigger impact. But so it's incremental, but I think it's more psychological, particularly, potentially for interstate buyers who would otherwise have considered Victoria.
Yeah. Yeah, and the psychological makes an impact, and we're certainly seeing a decrease in investment in Victoria with our data. But on to perhaps some more positive news, and throwing it over to you, Cate, because I know you have quite a lot of fun with this data. The consumer sentiment. Talk to us about the consumer. How's the consumer feeling?
Okay, I'm a little bit encouraged by this, although it's come off a fraction from 82.1 to 81. But if we have a look at how people feel about family finances versus a year ago, that's not looking so great. But family finances for the next 12 months has tricked up a little bit, and as has economic conditions over the next 12 months. Now, economic conditions for the next 5 years has come off a little bit. So all of this is indicating that people aren't really sure how the future's looking. Time to buy a major household item is almost identical. So we're still a little bit gun-shy about spending money. And that says to me that it's starting to pinch, and people are very cognizant of saving their pennies now and not buying stuff they don't need. And time to buy a dwelling is at 72%, which is probably as low as it's been since we've been doing this. So it's a bit of a telling chart.
What about, Dave, the interest rate expectations index? That's a bit of a surprise because, we've had some pretty soft economic numbers that are, making some commentators say that, well, even some of the ones that are saying we probably won't see a drop till 25 are bringing it back into 24. And, people like the kook, Stephen Koukoulas, who's been very kind of what's the word? Dovish, I suppose. He's sort of saying we're not going to have any changes in February, but March could be on the table for a cut.
I think he's getting a bit excited. I think the data I've read, I think it's less likely to happen in the first half of the year, and we may not even see a cut in 2024. I think it's a possibility. But yeah, look, people have been reading their headlines, haven't they? Because interest, that was one of the ones that sort of stood out. Interest rate expectations dropped from 159 to 147. So people are, getting more positive about what's likely to happen with interest rates. What I did note, though, is the average interest rate expectations over the course of the however long this survey's been running for has been 154. So people generally are not too positive about their expectations on interest rates, despite what we've come off this long period of really low interest rates. So that's interesting as well. Look, it feels like to me not much changed. People, when on one hand they're saying rates aren't going to go any higher. But on the other hand, I'm buying all these Christmas presents for everyone, and I'm paying for the holidays. And gee, I don't have as much money as I wish I did in the bank account. And so I think it's a bit of a holding pattern month. And there's but you do look at house price expectations. It's interesting. Like at the start of 2023, they were down at 104, which is we were coming off negative price returns in 2022. And then you look now, they're up at 158 12 months later. So people are certainly thinking prices are going to continue to grow in value significantly.
Yeah, it's up 51% for the year, right? Or 52 rounded up. It's crazy.
Yeah.
Now, Cate, you mentioned 80-20 owner-occ to investors, but the lending indicators, which a little bit lag, published 2nd of November, say that investors are coming back with a vengeance.
Yeah, that's right.
The yearly percent change is higher.
What you've overlooked, Mike, is I'm in Victoria, not WA.
Oh, yes. Yeah, all the money's
I'm
going.
I'm not the barometer for this one. Unfortunately, Victoria, I've seen in other polls, is the least favoured state. I think there's a great opportunity there, and I will always openly say that I have to be biased, as much as I don't want to be. I look at how we've slipped in terms of just our median values compared to other states and what the disparity is, and also the fact that some of these silly changes aren't necessarily forever. I think Melbourne represents great buying, but does it mean that it's about to take off and go nuts in the next 6 months? I don't think so. So, no, I'm broadly helping owner-occupiers now, and it's obvious why.
The sad thing is I think you'll get busy with investors once green shoots appear, but really that's not the great time to buy, right? You've got to have confidence to buy at the bottom, and those people that were buying during COVID at the beginning before prices started to move upwards, chapeau to them for really, backing their convictions. And now is the time to potentially back your convictions in Victoria. How much further can it go down, or how much less competition could you have? And then you see, we get into places like Perth, the competition is so strong that it's nearly impossible to find stock at the listed price.
Yeah. Yeah.
Dave,
yeah. Look, on the ground, we had more people buying property in the last 2 to 3 months of the year than the first 6 to 9 months. So, certainly our clientele, and we do spread more across all of Australia, but people felt like they, were at the top of the rate rises. People were feeling more confident to purchase across our client base. So that certainly picked up. So this is November numbers. I do need to start actually. I need to start actually collecting our data on the breakdown of owner-occs versus investors, and percentage of purchases versus refis. But certainly, the percentage of purchases increased significantly on the ground for us in the last 2 to 3 months, and that's flowing through with our January settlements, for example.
Interesting, and the data is showing that the refinancing gold rush season has kind of come to an end, right? That fixed rate mortgage cliff has been navigated as more of sort of just a gentle sort of mobility ramp.
It's just starting to level out and maybe pick up again.
You love these metaphors, I can tell.
Yeah.
This is what you miss
metaphors.
if you don't watch us on YouTube, is Cate sort of shaking her head going, why do I put up with this rubbish? Now, someone has put a giant
ramp, though, that's gold.
Thank you. I'm here all week. Someone has put a giant arrow on my notes for what looks like construction lending data that happened 2020. Who wants to talk to me about that?
Yeah, well, look at that rush when we incentivized people to get busy with renovating and building, and look at how quickly it tumbled down. And we do have a real issue with new starts, but also new loan commitments. You can see clearly we've had a lot of big builders go out of business, and we're not seeing that volume with lending for construction loans.
Yeah.
And that's also the problem with fixed price contracts when costs of the goods are going up so rapidly.
Yeah.
Yeah, and it created quite a few supply shocks as well. Dave, over to your special subjects. Government bonds, unemployment, wage price indices. We could go mad on all of that stuff, but what have been the key takeouts for you?
Well, look, I think our Reserve Bank rate's at 4.35. The 3-year bond yield was 3.84, which was implying 2 rate reductions over the next 3 years. So whenever they may occur, the 10-year is up around, well, where rates are now. So overall expecting long-term this to be sort of our new benchmark level for interest rates.
It was always the old, like, this is representative of normal. I know that people are freaking out and there are other things that are really making it difficult for a lot of people with mortgages, but we are not above historical norms. It's just that we had such historically low, ridiculously low rates for so long, people got used to them.
Yeah, 100%. Look, with jobs, I think the canary in the coal mine is the monthly hours worked in all jobs is reducing. So that fell by 5 million hours in the last month. So I think, we'll continue to see the uptick in the unemployment rate. What else did I notice in there was some good signs in productivity. So we actually had a bump in one of the areas in productivity, which we hadn't had for some time. So that was, so that was good to see. So we might be seeing productivity. Look, a risk to rate reductions as well is our growth in salaries. That still looks like it's going up. 4% is about where you want it to be if you have inflation at 3% and productivity at 1%. But that's not the case. As we know right now, productivity has been in negative territory and inflation's above 4%. So again, these are little things that suggest to me we might have to wait longer for rates to start coming down.
Yeah, who knows what the future will hold with that. I think it's welcome to everybody that's lived that period of historically low rates, but the media would say interest rate hikes, like there's only ever a hike and a backflip. You change your mind or new evidence comes in, you do a backflip. If you put something up, you don't raise it, you hike it. It's so emotive. But the RBA said, I don't know, for maybe like 8 meeting minutes in a row, we are returning to more normal rates, right? It's not a hike. And Cate is absolutely right. I think we would do well to consider now to be sort of like a bit of a long-term equilibrium, except, allowing for those 17% interest rates and all the stuff that we saw before the dollar was floated. But this is kind of a bit normal. But yeah, hopefully the couple of rate cuts that we see priced in will eventuate, because I think that'll make everybody happy, right? And hopefully will stimulate a little bit more construction, which we need.
It won't make your old mate happy who said he wished rates would just keep going higher.
He wanted them at 20%
in the media.
Will it make APRA happy? Will they start to look at the servicing buffers and change those up? I don't know. That's my prediction for this year. I know I said it for last year. I was just a year too early, I think.
A lot of those comments we made were just early. Yeah. I think they do need to look at it. Absolutely. And I think they need to look at the interest rate differential between investors and owner-occupiers. And unless they can point to a material increase in risks of default, then what's it doing rather than disincentivizing people to invest at a time where we need rental properties in lieu of supply, right?
Yeah. Seems like a really logical one, doesn't it? We need rental properties. How about we make interest rates on loans for investors back at the same rate as for owner-occupiers?
That'll bring investors back, Dave. We don't want that. We just want to build lots.
Not those bad investors who...
Now, before we go and get cancelled by the left-wing powered elites, we probably should go to our gold nuggets.
Now it's time for us to go mining for our gold nugget property tip of the day.
Now, for all those people out there who are planning on purchasing in early 2024, especially if you're looking for a property that might be under the median purchase price in the area, because we know that we're getting a lot of investor stock hitting, I think it would be a great idea to stay close to the agents, let them know what you're looking for, talk to them, and remember to give them feedback when you see a property that you don't like. That will keep you in their good books and they'll know what you're looking for. You might just find that they can swing you some options before they go to market. So good luck.
Good advice. Dave, what have you got for us?
Look, I think it's the same old boring advice. Despite how interesting these market updates are, just make your own decisions based off your own personal economy and what's right for you. Don't get caught up in, the monthly gyrations. If you're ready to buy, know your price point, make sure cash flow is right for you, what's affordable, and then go and make a decision in the right property market and the right property that suits you.
I love that. I
Never
think we'll leave it there. Boring's always, but boring tends to be the most likely to be of value to people. The shortcuts are at the butcher shop.
But Shakespeare say, simplicity is the ultimate sophistication.
There you go.
Oh gosh, you guys are absolutely on fire this morning.
Let's shut it down before it gets any worse. Thanks for joining me, guys. We'll see you next week.
See you next week.
Want some photos of you in your Hilfiger t-shirt with your suit jacket on, hungover after the big bash, Mike?
Mate, all you need to do is go to Channel 7. I'll hook you up.
Flick it to him. It's good.
Put it on for our let's put it on for our listeners.
You took a Barocca and had 10 coffees. I thought you did a great job.
Yeah, no, cheers. Next time I won't give myself those impediments, but you live and you learn. See you next week, guys.
Catch you later.
Gotcha. Bye.